Investors Chronicle.
Welcome back to the Companies and Markets Show. It is Thursday, the 4th of August, 2022. We're recording at around 2 p.m. On the show today, we've got Michael Fahy. Hi, Michael. Welcome back.
Hello.
Good to have you along. Alex Newman. Hi, Alex.
Hi, John. How you doing?
Good, thank you. Welcome back from your trip abroad. Mark Robinson. Hi, Mark.
Hi, John.
And hosting as normal, Dan Jones. Hello, Dan.
Hi, John.
Coming up on today's show.
Yeah, we've got a tale of two turnaround stories this week. Pearson and Rolls-Royce, one of them turning much better than the other at the moment, of course. And we're also discussing our cover feature as usual, which this week is on accounting scandals, how policymakers are trying to prevent them happening again, and perhaps more importantly, what private investors can and should be doing to spot these problems themselves.
Juicy stuff coming up. Before then, a quick news roundup as normal. Today, as we record, Thursday lunchtime, the Bank of England raised interest rates by 0.5 percentage point, the biggest single increase since 1995. The bank has also raised its inflation forecast to 13% and now predicts the UK will fall into recession in the last 3 months of this year. Elsewhere this week, energy companies announced more record profits. BP saw a 14-year high quarterly profit of £6.9 billion, following Shell's £9 billion profit. Meanwhile, miner Glencore has seen half-year profits of $18.9 billion off the back of strong performance from its coal business. JD Sports has a new CEO. After the dramatic exit of Peter Cowgill, the company has appointed Regis Schultz to take the top job. Schultz previously ran French chain Monoprix. Uber posted its first ever positive free cash flow quarter in its history. Our colleague Arthur Sants has a good write-up looking at tech companies such as Uber's pivot away from growth at all costs models in these inflationary times. You can go and seek that out on the website and in the magazine. Speaking of write-ups, we've got 66 company results in our magazine this week by my count. I won't mention them all, you'll be pleased to hear, but here's a quick flavour. Domino's Pizza has seen higher wheat prices and driver shortages cut into profits. The company reported a fall in pre-tax profits for the first half of the year. Jennifer Johnson has maintained its buy rating, however, in the write-up of this one, so you can go and see why she's so bullish in the mag or online. Sticking with fast food, Greggs has delivered a steady set of half-year results with like-for-like sales growth of 22.4% versus 2021. Our very own Mark Robinson with that one. And HSBC's half-year results were overshadowed by its chief executive Noel Quinn's efforts to prevent separation of the bank into European and Asian divisions, something that's been demanded by its largest shareholder, Chinese insurer Ping An, and Julian Hoffman has the write-up on that one. FTSE 100 unmoved this week at just under 7,500, but Wall Street is in the green, with the Nasdaq in particular picking up 5% in the last 5 trading days, accurate to time of recording as always. Let's get on with the show.
Thanks, John. Yeah, as you say, we do have a thicket of results still. We're still in the middle of reporting season, so we're going to look at a couple again today, starting with Pearson, which, as I said, the top is a bit of a turnaround story. Gone through several years of trying to turn around, rather unsuccessfully, but now does appear the situation appears to be improving, and those initiatives do appear to be bearing some fruit. Mark, our company's editor, has covered the latest interim results. Mark, is that a fair assessment? What are your thoughts on Pearson as it stands?
I wouldn't necessarily use the term turnaround anyway. I think this is an evolving story with Pearson as well. Readers or listeners will probably remember its status at one point. It was a kind of mini conglomerate in a sense, but a strange one at that. It's almost as if their acquisitive habits in the past are on par with a monopoly board, because at one point they obviously had, they owned the IC, of course, but also Penguin at one point, The Economist, had a stake in Madame Tussauds, and it was a real hodgepodge. And so I think probably about 10 years ago, they started streamlining process itself and moved on. Well, it's turned out to move on almost exclusively now to digital education. I guess looking at the most recent half-year results, they can be encouraged to a certain degree, but the issue is obviously clouded because the main question, as far as I could see, is that what long-term impact the changes that were wrought by COVID-19 will have on the business, particularly with regard to the wider educational establishment. And we're not really sure on that yet. Results have suffered over the last 18 months or so because obviously many schools have been closed due to lockdown, and there was an artificial boost to their digital channels as well. The question is, of course, how much is that going to stick, and how is it a point to the future of education? Most of the business stands actually, with the exception of higher education, gained momentum through the period. Probably the standout was the English language unit, where I think sales are up by about a fifth. The company puts this down in part to increase global mobility. Obviously, a lot more people out there who are interested in learning English. The app's done well enough. I think it was launched last year. That increased by about 64%. So they've got now 4.5 million paid subscribers, and a great deal, many more that are just linked to the app itself. Results benefit through the year through a large currency gain as well, but that swings and roundabouts, of course. Pearson has a high degree of exposure to foreign currency, particularly the US dollar. So that may have inflated the reported results too. But I think shareholders are going to be broadly pleased with the results as well, because it does seem to suggest that, at least from a strategic point of view, there's more clarity now.
Yeah, just to not to get into a bun fight about it, but yeah, I suppose the turnaround terminology, what was from the point of view, there are some green shoots there which do seem to be finally coming through after so many years of promising this kind of shift to digital. It hasn't really materialized. Obviously, in some ways, the pandemic helped when everyone had to shift to digital. But there were some interesting bits in there for me as well about, you talk about that kind of global mobility, that English language aspect. They also seem quite keen to emphasize their kind of upskilling, in work, that kind of area where there's potentially some fruitful ground in terms of companies looking to help their workers gain more qualifications or just do a little bit of learning on the side, that kind of thing. So it seems like that's something they're quite keen to push now, which might make sense certainly from a marketing point of view when there is this uncertainty over education and how people will respond there post-pandemic.
Yeah, I mean they're pushing this line about lifetime learning as well, and I guess that encompasses it too. I mean there is a general skills shortage through the economy. So at least theoretically, that should provide support as the years roll by. It also received the company also received some support in the market due to recent upgrades by Deutsche and Morgan Stanley. So I think that helped support the share price on results day too. But, as I say, I think there were positive and negative impacts through COVID-19. We just don't really know yet in terms of what's going to happen with the virtual schools segment going forward, whether the boost it received through the pandemic, whether that much of that sticks. Anecdotally, I've heard differing opinions on just how effective that is as a learning tool.
You did see, I think, the US company Coursera, which is quite a pioneer in this area, did put out a bit of a warning the other week as well. But I suppose where these things come together as well is going to be, Pearson says it's, as a lot of companies like to do at the moment, unsurprisingly say they're, relatively recession-proof. Historically, education has been quite recession-proof because, people go back to it when they lose their job in a tough market. But then, if we have a recession with a strong jobs market at the moment, does that mean fewer people go back to education? Does that mean people do more business learning, the skills shortage, that kind of thing? How do all these things net off against each other is quite interesting. And yeah, I'm not sure anyone knows the answer.
Yeah, particularly as the job market, that might change appreciably over the next 6 months, I imagine.
Yeah, that is true.
Just to chip in, if I may, I think it's certainly working itself out, isn't it? This global digital education kind of blue sky that they're aiming for long term. But I wondered, particularly with the Apollo approach early this year, which obviously came and went, though the share prices continue to push on since they withdrew their bid, is that the sort of long-term outlook for education is that surely at some point companies, and it might be Pearson, it might be others, are going to work out how to marry the two, digital and education, successfully, and marry it with the global platform model with excellent margins and sort of good distribution networks. That could be sort of really powerful for the sort of long-term investment case. And it's interesting this week in the mag, Leo carried an interview with Alex Savides at JOHCM Dynamic, who, I mean, for him, he sort of painted it as a bit of a Marmite story. And I think in the piece we referenced that Nick Train sold down his holding in Pearson because he wasn't convinced that selling, sort of this digital education push was working. But Alex Savides' view is that, that's really been their core focus now, and it's a really smart one to go after, having shed all these non-core assets. So, I think there's going to be a lot more shakeout and probably more disappointments, and currencies are going to swing back in the at some point. But I think it's quite smart. It's a smart place to go after, particularly if you think of how unsustainable, for example, the US higher education market is heading, and the opportunities for disruption may be there. So
we'll see.
2 cents.
Yeah.
We'll see.
I think that it's a good summary, isn't it, of the short-term headwinds, clouds, uncertainty, and the longer-term, opportunity. I think, as Mark says as well, they are priced relatively healthily at the moment based on some of these forecasts as well in the near term. So the hold which it is on currently seems like a sensible position.
It's not crazy. It's not crazy valuation. Like 15 times 2024 earnings, I think now. It's for a platform business could look cheap in a year's time.
Yeah, and given the fact it's more a high proportion of its income is going to come through subscriptions as well. That point you made as well about the US educational establishment is valid too, because it's not just a case of the incredible costs that are involved in going to university in the United States. I think the average degree is pushing £200,000.
Wow.
But it's also many of the degrees themselves aren't generally seen as being helpful in getting candidates jobs going forward. You're going to see a switch to, I think anyway, in line with Germany, you're going to see a switch towards community colleges, as they're called in the United States, and that in itself presents another opportunity for companies engaged in digital education.
It's finally balanced, I think we can say at the moment for Pearson. But we'll come to Rolls-Royce, our other result of the week, in a minute. But let's first turn to our cover story this week, which is on the exciting world, or not depending, if all things go well, of audit reform and accounting scandals and what can be done about them. Obviously, we've had a few high-profile collapses in the UK over the past few years, not just the UK, the likes of Wirecard, obviously, as well, in Germany. And really the piece, Mike is here, the author of the piece, is looking at both what these kind of reforms are in the UK, what's actually going to change, but also, as we said at the top, what investors can do themselves when they're looking at reporting accounts, to see these warning signs. Because in a lot of cases, these signs were there. It's easy to say now, of course, but, there are things you can look at. So let's just start, I suppose, with the changes to the audit regime. There's been a lot of criticism, obviously, of the Big Four in the way these audits are conducted. Whoever is charged with auditing a collapsed company obviously comes in for a lot of criticism. What are policymakers trying to do about it?
So, to go back a slight bit, these reforms have been a long time in the making. There were 3 separate reviews of the market following both Carillion's collapse and also BHS and the problems that left, particularly for pensioners. So there was one by Lord Bryden into the quality and effectiveness of audits. There was one by Lord Kingman into the FRC, the Financial Reporting Council, the Auditors Watchdog. And there was a review of the market by the Competition and Markets Authority as well, given the dominance of the Big Four. And the draft bill was a long time in the making. There were 155 different recommendations, apparently, and the draft bill was finally published in May, which, when it was, there was some criticism of the scope. A lot of people wanted to see recommendations of company boards to make statements on internal controls. They were billing it as a Sarbanes-Oxley for the UK. That was watered down. The government has talked about doing it gradually and introducing a more incremental approach. Many of the people we spoke to, the accountancy bodies, and some of the interested parties, the auditors themselves as well, just kind of want to see some progress with this. They want to see it move on now because it's been talked about for such a long time. The main points of it, I suppose the main principle is to replace the FRC itself with a new statutory body called ARGA. The problems with the FRC are twofold, really. One is that it's funded by the industry itself. The second is that it only really has powers over auditors or over accountants. It has no power over most directors. So the idea with introducing ARGA is to have a body with more teeth and a body that can look at more of what a company puts out than just the financial statements, because the FRC is limited very much to the numbers, whereas ARGA will be able to pick over the entire annual report. It will have oversight over things like the nomination committee, the audit committee, and all kinds of declarations that the company makes, even over things like ESG.
The proof will be in the pudding, I suppose. But of course, the issue for a lot of investors is by the time these bodies step in, the damage has been done, certainly in terms of share price on a lot of occasions. Speaking of damage to share prices, you did speak to some short sellers as part of this piece to look at the kind of thing they look at, including Carson Block from Muddy Walkers. I think had some interesting comments as usual on this kind of thing.
Yeah. I mean, he was very good fun. I was just talking to Alex about our conversation on the way down here, and there was plenty of it that was not repeatable on a podcast such as this.
Alas.
Yeah, but I mean, one bit that is in the piece is he argues that really the only effective function an auditor plays is to make sure the cash balance is there. Everything else is just around interpreting the rules. Investors who think they can rely on an auditor for protection or for sniffing out fraud, his belief is that that's just mistaken. And you shouldn't rely on auditors to guarantee that the numbers in a set of accounts are safe and are a true and fair reflection, which I think is, for many private investors, that would be a concern.
Yeah, it's definitely a concern, but I think also that's why we, focus a lot of the piece on things they can do, things they should be looking at. Can we talk about some of those?
Sure, yeah.
Without giving away all the tricks of the trade, you have to pick up the mag for that. But
I just wanted to go back, if we can, to the reforms as well, because
Yep.
I think one of the interesting things around the CMA's review and the proposals is this idea that the Big Four themselves are almost like a systemic risk, really. One of the proposals is that public interest entities, PIEs as they call them, basically any firm with a turnover of 750 million or more, will have to have at least part of their audits conducted by a challenger firm, i.e. one that isn't part of the Big Four. The point behind that, I suppose, is to build resilience and to ensure that the market isn't reliant on the Big Four. But the issue with it seems to be, I spoke to Dr. Roger Barker at the IOD about this, is whether or not this will have any kind of practical use at all, or whether it just ends up being a replication. Does the challenger firm have any kind of meaningful input or influence, or is it just going to be an additional cost for companies?
I suppose there's an issue there as well, insofar as some of these challenger firms, there was a company recently, I can't remember who it was, but they attracted a bit of, not even criticism, just derision for saying, we're going to be checked by, a top 15 auditor or something. They don't have the credibility to begin with. And obviously the idea is over time, we need more than the Big Four to have credibility.
Well, that is a problem, because if you look at some of the scandals itself, Patisserie Valerie is one that's brought up, and that was one of the few large companies that was audited by a non-Big Four auditor, Grant Thornton in that case. And also the FRC, although it is very keen, and ARGA, as its successor, is very keen to kind of build resilience in the market, it's been quite critical recently of the standard of audits done by some of the non-Big Four firms.
So let's get to some of these, accounting practices or things to look for. I mean, it's fair to say that the cash flow statement is really where one should not start, then maybe finish your analysis, but certainly look very closely at when you're trying to establish what is going on at a company.
Yeah, that was, I think, is the standout from, we pointed to 10 red flags, and the standout, I think, is that you really have to understand the cash flow statement and to know the difference between how the cash flow statement translates against the profit statement. I mean, Carillion's a good example. It had 4 years of very good operating profits in the last 4 accounting periods before it declared a massive write-down and went bust. But over those 4 years, I think it had a cash outflow of something like £200 million.
I think the metrics as well we discuss are important. There's in financial analysis, there are any number of ones you could pick and choose from. But when you look at things like cash conversion, for example, is a key one, as you say, to establishing how real those profits are in some cases. We also talk about things like revenue recognition, of course, and various other things, when it comes to, creditors, debtors, things like that, those kind of
Yeah, and every
issues.
issue, there's a bit in there on, it's really important to understand the working capital, and particularly movements in working capital and the relationship between working capital and sales, and also the changes over time. Some companies, Patisserie Valerie again was one where it was carrying really, really high levels of inventory for what it did, and the days sales outstanding. It had really long periods where its turn on inventory was, I can't remember, something like 80 days, which is quite amazing when you consider it was a business selling cakes.
Yeah, you wouldn't want an 80-day-old cake, yeah.
Absolutely not, no.
And yet,
80-day-old, rather.
And yet, at the same time, I think you point out another one of the things that investors should always be aware of. I think this is a really hard one to spot, but in the case of Patisserie Valerie as well, their margins were just a lot wider than competitors, and that
was
in itself
something,
a red flag.
Yeah, that was something that when I was speaking to Carson Block and we were speaking about NMC Health, which he published a report in December 2020, I think, suggesting that it had inflated its cash balances and understated its debt. The spiral there was quite amazing. Within a couple of months, the company had brought in an independent investigator, and this independent investigator started digging around and found all kinds of off-balance sheet loans and other mysterious debts. And one of Carson's lines, which isn't in the piece, is he says he's a great believer in the cockroach theory, in that if you find a cockroach, there's never just one. And with NMC, there were plenty. So within him publishing the report, 4 months later, the business was in administration, and its debts were something like $4 billion higher than were actually stated on its balance sheet.
I think, ironically, in reference to that investigator, I believe, unsurprisingly, they ended up owing that investigator a lot of money as well. That was in the administrator's report. Even though they got them in to investigate the company.
Yeah. And not only was it NMC as well, it also triggered a similar sort of spiral down with Enabler, which was supposedly a payments and technology company that owned Travelex, the foreign exchange company, as well. And there was some cross-ownership there with NMC's founder, a guy called Dr. B.R. Shetty. The unwinding of that was, again, this isn't in the piece, but it's quite interesting in terms of one red flag that companies need to look for in terms of related party transactions, because he was a majority shareholder of Enabler as well, and there were some share pledges that once one started unwinding, affected the other.
Yeah, Finabler, I think, is still suspended, isn't it? NMC Health has come out of administration this year, though. It's still functioning. So you do... These things aren't always fatal, even if they are pretty bad for shareholders at the time.
Well, it's
another
fatal for shareholders,
yeah.
definitely.
NCC is another one mentioned, which obviously has had issues of its own, but which has actually recovered quite well and is a buy tip now.
So I was going to say, there's an interesting point. There's a really, really good bit of research out from Liberum last year where they and at some point, I'm going to try and turn this into a stock screen if it's possible, to sort of like a red flags, almost automated approach. In their research, they looked at something like the sector which was most overrepresented in the revenue misstatement sort of calamities of the last couple of decades were computer or tech companies. And I mean, I think it's exactly the reason you mentioned is that the high growth industry with significant intangible investments, which can sometimes backfire or incur large write-downs because they're quite over time. You have to adjust the amount that the capitalized spending is going to generate in cash in the coming years, particularly in really competitive areas. So it's that's both I suppose an understandable corporate misstep situation, but also with the capacity for sort of balance sheet padding, essentially. That's one industry that investors have to pay real attention to. Not to mention the way they charge. They structure some of their services as well and accrue in advance of selling some goods as well.
Yeah, and every of the red flags that we mentioned as well is M&A. Again, not just NMC, but we talked about Wirecard as well. And one of the things that was found in the fallout from Wirecard is that it had bought 3 companies in India, which it supposedly paid about 300 million euros for, and it turned out it actually only paid 30 million. And Carson Block was saying that doing deals with friendlies, as he called them, is if you're generating fake profits, then you have this problem of fake cash, and somehow you have to get rid of that cash. And M&A is often, and overstating the price that you pay for something is often one way in frauds in which they've been able to kind of burn off that fake cash.
We've covered a lot of ground here, and there is a lot to cover on this topic, but I think it's one of those where it is good to have it set out in front of you, which is why I would encourage you all to go and check out the feature itself. Okay, let's go back to results for our final segment. If Pearson can't really be described as a turnaround, then this company certainly can't at the moment. Rolls-Royce had its interims out today, and it's another case of jam tomorrow, really.
Yeah, it is. I started at EIC about a year ago, and Rolls-Royce was my first ever buy idea in it. And I feel like quoting Dr. Berry from The Big Short by saying, "I may have been early, but I'm not wrong." And yeah, as the retort was in that film, it's the same thing. Rolls-Royce's shares are down a third this year. The recovery in aerospace is really the thing that has weighed against it. It's had jets caught up in Russia that were parked for a while and weren't doing anything. You've got the whole long-haul travel, and long-haul is where most of its large engines fly, and it makes money from the amount of time they spend in the air. In long-haul, you still got a big problem in East Asia as well, in China, and the recovery of long haul in Asia is still really, really weak. So that has been really the thing that has slowed its comeback or its turnaround.
Yeah, obviously there is a new CEO coming to Rolls-Royce soon, I think start of next year. Is it too soon for there to be an element of kitchen sinking? You could probably describe each of Rolls' last few results as a kitchen sinker.
Yeah, and I do think, I'm bound to say this given that I put them on a buy, and I still think as a long-term idea, they've got a lot of potential. But I do think there's been progress made. I mean, yes, it's made another loss, and it's still burning cash, but at nowhere near the rate it was. You're talking in the first half, the cash outflow was 68 million, but that's down from 1.2 billion in the same period last year and 2.9 billion in the first 6 months of the year before that. So there's been a swing of about 1.1 billion of cash flow improvement. And that's mainly because although the aerospace division, as we've just said, isn't recovering as quickly, any kind of recovery there means, it's just kind of feeds straight through to the bottom line, really.
Mm.
It's done quite a big job in the past couple of years in terms of rationalising and cutting costs and shedding thousands of jobs. So it's a much fitter business now. It just needs that top line pickup. And it's not all bad either. The defence business also still lost money during the first half, but it's certainly showing signs of improvement. And they were saying that this is a real long cycle business in defence. You can't, although the picture for defence companies in the last 6 months looks a lot brighter for unfortunate reasons, it's not something that's going to feed straight through to Rolls-Royce's results in the interim.
Yeah, and power systems were, a bright spot as well. I think they were talking about, a lot of backup supply and people concerned about the winter, which, has actually translated relatively well for them at this stage.
Operating profit in that division trebled to 119 million, much higher margins, although that did have a kind of more of a build-up of inventory, which is sort of obvious, really, if you're doing so much more business.
I think, again, they're trying to get ahead of what they see as more semiconductor shortages coming, but
Indeed,
from the results call, they seem to be quite optimistic that that inventory should be enough to see them through.
And I think the other main reason for optimism with this is the nuclear arm. It's still, at the minute, it's kind of pre-revenue, as is the hydrogen business that they just did a deal with EasyJet on at Farnborough. But there's been quite a lot of progress with the small modular reactor consortium. Within the last year, they have got a big piece of funding from government. They've agreed a bunch of private sector funding. They've got money from the Qatar Investment Authority. They have set up physical presence for the HQ in Manchester. They signed a big deal recently to set up the first of the factories. So there's a lot of progress there. And yes, that could be something. The design process for that is going to take an awfully long time because of the nature of what it is. These are nuclear reactors, a type of nuclear reactor that has never been built. When you're talking about 15 of these in the UK, and that then maybe being a footprint that could be exported all over the world, especially in times like this where energy security is such a big issue, then I do think there's still some potential here.
Let's just to finish this segment, let's go back to the aerospace, the wide bodies. Is an interesting point you say about, the way that cash drops through very quickly. Yeah. I think long haul, their business, they're at about 60% pre-pandemic. They've said, I think in the past, they've said 80% would be, about 800 million of cash flow. So they're not too far away. There is that question of China, I suppose, what happens if, because that is a segment of the long haul business, with what happens to travel there. But
that's the key segment, really. I mean, when you look at everywhere else in the world doing long haul, the Middle East is booming again. It's kind of back up above pre-pandemic levels, and the appetite for transatlantic travel has been really, really healthy as well. So it's really just the China traffic that's the last piece of the jigsaw puzzle.
Yeah.
And if that improves, and it is an if at the moment, then I think you could see a real quick drop through again on that operational leverage.
I wonder how high it could get without China though as well. I think they said they're seeing sort of 65% post reporting period. You do long haul, a lot of it is just internal US flights, isn't it?
Yeah.
So maybe some potential even without China. But
yeah, so they've guided for 60 to 70% this year. They are quite positive that they will achieve that, and they're still, the target they had set for recovery to pre-pandemic levels was 2024, and they are sticking to that. So,
and then the new question, I suppose, for everyone next year is the new CEO. There was quite a positive profile of him in the FT the other day from his time at BP. So, hope springs eternal. I think, compared with the incumbent, I think the only way is up.
I suppose if you've been a long-term holder of Rolls-Royce, you may be rolling your eyes at this because hope has sprung eternal with them for quite a long time and hasn't been delivered. He went into the pandemic in quite an awful state, really, and was already carrying a lot of debt, and then has had to deal with a couple of years of no flying or really, really reduced flying. So its balance sheet is still in quite an awful state, but the Spanish government have just agreed or just sanctioned the sale of their ITP Aero business, and that is expected to conclude fairly soon, and that'll bring in another 1.3 billion. So again, hopefully its debt position should look a little better by the end of the year as well.
Actually, there's an interesting comparison as well, because we were talking previously about auditing standards and how they can differ. I mean, part of Rolls-Royce's problems for a long while was its accounting treatment, particularly in relation to revenue recognition, because of after sales is such an important part of the business. And I think it must have been going back to 2020 when they altered the basis of accounts there. So I mean, I think in the past that was hiding a multitude of sins. But by the same token, we shouldn't forget, the problems that they had, sort of prolonged problems with the Trent engines cracking and metal fatigue over a while, or composite fatigue over a certain length of time. But they did receive kudos in the industry as well, because they were very straightforward with the market on those problems, and they addressed it relatively quickly given the technological challenges there. So, I mean, we shouldn't be too hard on Warren East there. And Michael, I know this has weighed on you heavily, the Rolls-Royce idea, but I tend to agree with you as well. I think the strength of the company are still there. It's one of the few large-scale UK industrial companies that's at the forefront of the technology too, and I think the government now is taking very seriously the small modular reactor as a way of mitigating our energy shortfall. So I'm with you all the way, Mike.
It's good to know that Rolls-Royce has got at least 2 believers then.
Yeah, need a few more, but hopefully they will start emerging before too long. On that note, that brings us to the end of the show. We have run out of time, but thank you to Mark and to Mike and to Alex and to John. And thank you to you, as ever, for listening. We will be back with you next week with another Companies and Market Show.